Well, the pre-open has kick-started, so just a quick glance. It's flat. It's very much in sync with what the implied open was telling us. 15 points higher on the Nifty. That's the sense for now. Let's put the spotlight on the oil and gas space. Of course, there's the fall in crude oil prices, which we have to take stock of. And then yesterday, IGL took a price hike. That stock was surging almost 6-7% higher. So let's discuss all of this with Dayanand Mittal, oil and gas analyst at JM Financial Institutional Securities. Dayanand, great to have you on. Let me actually start with IGL as a story, as a stock. Yesterday, of course, lots of excitement. They've taken this 1 rupee hike, I think. They took one in April. Now they've taken one in May. What's your sense on the stock? Because otherwise, there's a lot of regulatory overhang. Every now and then, this gas allocation ends up becoming a bit of a problem. And then more importantly, they are an NCR, entity, largely NCR based. And the policy in NCR, seems to be shifting a little more towards EVs. In fact, in between, there was this whole talk of completely phasing out, the three-wheeler fleet and making it all EV over the next 1 to 2 years. Your thoughts and call on IGL.
Yeah, thanks, Surbi. Thanks for having me. So yes, I agree. IGL, we have a structural sell on IGL and MGL, given both are CNG-dominated companies with 70% volume comes from CNG. And as you rightly mentioned, there are two key structural challenges here. One is the APM allocation, the cheap APM gas allocation is on a gradual decline, though partly they were protected because this was largely replaced by new well gas, which is not very expensive, 20% higher than APM. So they were largely okay. But on a medium to long term, given new well gas is part of that APM portfolio only, and overall APM portfolio is on a gradual 6-7% annual decline. So most of this APM allocation has to be replaced by LNG imports, which is at least 50 to 70% higher than the APM prices. So structurally, the pricing power in CNG will gradually deteriorate. And second key structural challenge for both these companies are that the EV policy, which particularly in Delhi, government is implementing on a kind of fast track pace, given the pollution concerns there, that impacts the terminal growth in both this business. So there's no visibility whether after 10 years IGL CNG volume will grow at 0%, 3%, or maybe minus 5%. So that's the reason we continue to maintain our sell rating on both the names. However, valuations are reaching are at a comfortable zone. They're trading at 13, 14 times P. So from that perspective, there was a bounce on these names given the price hike that it took. Yeah. So except for those trading bounces, which will keep happening depending on valuations. Yeah. Otherwise, I think from medium to long term, it's a structural sell on both the names.
Got it. Gas availability, and then the other is just this whole push towards EV. Before we talk about overall the fall in oil prices, then just to talk about also GAIL, if that's under your coverage, because yesterday there was a report suggesting that the regulator, PNGRB, is holding some sort of an open house. And once again, they'll talk about pipeline tariffs. What do you make of that if you caught that news? And what's your call on GAIL?
Yeah, so for GAIL, this pipeline tariff revision is long overdue. For them, this APM gas price assumption or the gas cost assumption that PNGRB had assumed during this 2023 tariff order was only $3.5 odd. But post that APM got deallocated for the gas transmission business, so they had to use LNG largely, which comes at $10 plus. So that reset in the tariff order needs to be done. PNGRB had done that reset for GSPL a few months back. So it's a matter of time before it's done for GAIL. And there's a public consultation document which PNGRB has floated, which suggests a sharp 30-35% hike in GAIL's tariff, largely basis the correction on the gas cost assumption. So largely it's a matter of time before that hike comes. So we have a positive view on GAIL, primarily because of that long pending tariff hike, and also the transmission volume, given India is gradually moving towards gas, improving in its energy mix from 6% to 15%, maybe not by 2030, maybe more longer term. So that should give a good 5-6% transmission volume CAGR in the medium to long term. And valuation also is reasonable for GAIL. So we like GAIL as one of our top pick in the gas space.
So GAIL is your topic, and you're factoring in at least a 30 to 35% upward revision in tariffs, in the pipeline tariffs, right? You're making that in your estimates.
Yeah, just that because we don't know the timing, we are doing it gradually over 2 years.
Sure.
Right. Dayanand, hi, morning. Oil marketing companies, what are valuations at, and what's your top bet?
Yeah, so the entire oil PSUs, OMCs, ONGC, Oil India, as you know, is a more top-down sector. So a lot will depend on two factors: where is crude prices stabilizing at, And second, what will government do in terms of either excise duty hike or fuel price cut? So first on crude price, so this OPEC surprise hike for second month took us also by surprise. I think there's a conflict between Saudi's short-term interest and long-term interest, and so does for US president as well. So though both parties would like crude to be at a relatively higher level, around 70, for Saudi, it helps them given their fiscal break-even is around 80, 85. And also they need to keep selling stake in Aramco to fund their Saudi 2030 vision. Also for US president, this helps him to use energy as a key source of export to bridge the trade deficit. So long term, both the key players in the oil market would like oil to be at a relatively higher level. But in the near term, Saudi is trying to protect its market share and ensure the two defaulting countries in OPEC plus, Kazakhstan and Iraq, fall in line in terms of complying with the output cuts. So it's a kind of a threat in our view to these two parties to fall in line. And for US president also, I guess this is more as a negotiating tool to get Russia and Ukraine agree on the negotiation. So low oil price means Russia has less bargaining power. So yeah, short term maybe oil remains soft, which might be positive for OMC's marketing business, hopefully till government changes in its view on excise duty and fuel price cuts. But in the medium to long term, we are structurally negative on OMCs more because of the huge capex which they keep doing on refining and petchem, which tends to be value destructive in nature. And also valuations for both HP, BP are at 1.5 times price to book versus historical 1.1. For IOC is largely in line at about 1.1 time price to book.
All right. I have more questions, but out of time, Dayanand. Thank you very much for joining us this morning, and we'll have you back. We'll continue and pick up on some of the points that you've made on that one. Well.